There is an old and useful truth about markets, seldom taught in business school, but well understood by anyone who has watched a herd of cattle bolt at a sound too faint for human ears. It is never the thunderclap that starts the stampede. It is the silence beforehand. Silver, this week, gave us the thunderclap. What almost nobody is discussing is the silence still sitting on the calendar, 3 days deep, waiting. Consider where things stand. For 7 long months, silver did what unloved assets do. It drifted, disappointed, and tested the patience of everyone holding it. Then, this past Thursday, a single government report, a disappointing count of just 57,000 new jobs against expectations of roughly 110,000, did what 7 months of grinding could not. It sent silver vaulting off its lows near $58 an ounce through $60, and, as of this recording, to roughly $62 to $63 an ounce, a move of real consequence in a matter of days. One number, one data point, a market-altering lunge. If you find that unsettling, you are paying proper attention. Here is what almost no one watching their portfolio this weekend seems to grasp. That was merely the overture. Next week brings 3 more scheduled economic releases, arriving on 3 separate days, each one aimed at precisely the mechanism that has governed silver's price all year. This is not speculation dressed up as insight. These are dates on an official calendar, as fixed and knowable as the tide tables, and yet most people holding silver will walk into the week with no more awareness of them than a sleepwalker has of the furniture. To understand why a piece of paper released by a government statistical agency can move the price of a physical metal more violently than almost anything else in the modern financial world, you must first understand the single lever controlling silver's fate. It is not mine supply. It is not jewelry demand in Mumbai. It is the market's expectation of what the Federal Reserve will do with interest rates. Silver, unlike a bond or a savings account, pays no interest of its own. It simply sits there, being silver, patiently indifferent to yield. When interest rates are expected to rise or stay elevated, the appeal of holding cash and bonds increases, and money drains from metal into paper, promising a return. When rates are expected to fall, that calculus reverses. Cash starts to look like a wasting asset, and capital floods back into the hard, tangible, ancient store of value that is silver. It is a mechanism as old as central banking itself, and this past week we watched it operate in real time, with textbook precision. Before that jobs report landed, traders were pricing in roughly a 67% probability that the Fed would raise rates come September. Within hours of the number crossing the wires, that probability had collapsed to something close to a coin flip, near 50%. Odds do not usually move by 17 percentage points because of one Thursday morning release. When they do, it tells you the market's expectations were balanced on something closer to a blade's edge than a foundation, and it tells you that anything landing on that edge next week has outsized power to tip it. Now name the 3 things landing on that edge. First, on Wednesday, the Federal Reserve will release the minutes of its June meeting, the meeting at which Chair Kevin Warsh did something genuinely unusual. He pulled back from the customary practice of forward guidance, declining to signal clearly what comes next, while the committee's own projections revealed real disagreement among its members about where rates should head. Wednesday's minutes are the closest thing markets will get to a transcript of what was actually argued behind those closed doors, and they will either confirm a committee tilting toward relief for borrowers or one still nursing anxieties about inflation. Second, on Thursday, comes the weekly reading on jobless claims, ordinarily a data point so routine that it barely earns a headline. Not this week. After the shock of last week's payroll figures, every subsequent claims report becomes a referendum on a single pressing question. Was that weak jobs number a fluke, or the leading edge of something more serious in the American labor market? Markets will read Thursday's number as evidence for one story or the other, and silver will move accordingly. And third, closing out the week, comes a reading on consumer inflation expectations, the quiet, underappreciated report that may matter more than either of the others. The Federal Reserve has said, repeatedly and without much subtlety, that its greatest fear is not inflation itself, but the moment ordinary people begin to expect it, plan around it, and thereby help create it. If that survey shows expectations climbing, the Fed's hands are effectively tied, regardless of how weak the labor market looks. If it shows expectations cooling, the path toward relief widens. This is the sleeper of the 3, the one report most viewers will scroll past, and precisely why understanding it now gives you an edge that the crowd will not have on Friday. Wednesday, the minutes. Thursday, the claims. Friday, the inflation expectations, 3 separate inputs into the same rate decision that has governed silver's price all year, landing back to back on a market that has just demonstrated in dramatic fashion exactly how sensitive it has become. What happens when 3 more sparks land on a market already? This combustible is not a matter of idle curiosity. It is the entire question of the coming week, and it deserves a closer look at just how combustible that market really is. Every market has a temperament, and silver's temperament is that of a coiled spring rather than a rolling tide. To understand why next week could produce something genuinely explosive rather than merely interesting, you have to appreciate the physical condition silver finds itself in as this data begins to arrive, because it is not approaching the week from a position of calm. Layer the fragile sentiment we just described atop a market that is, in the most literal sense, running short of the thing it trades. For 6 consecutive years, global consumption of silver has outpaced global mining production. Above-ground inventories, the buffer that normally absorbs sudden bursts of buying, have been drawn down by hundreds of millions of ounces. On the COMEX exchange in New York, the volume of metal actually registered and available for physical delivery is thin relative to the paper claims resting on top of it, a structure not unlike a bank with more depositors than vault cash, functioning smoothly until, suddenly, it does not. When a rush of investment demand meets a market already this constrained, the price does not simply rise, it can gap, because there is not enough physical metal to absorb the buying calmly. That is the coiled spring. Fragile rate expectations on one side, a supply-starved physical market on the other, each amplifying the other's every twitch. A genuinely dovish result across all 3 reports. Weak claims, a dovish set of minutes, cooling inflation expectations. Landing on this kind of market could ignite a move considerably larger than the underlying data alone would justify. I want to be honest with you, though, because a channel that only tells you the bullish story is not informing you. It is selling you something, and that is precisely the kind of transaction that ends in tears for the person on the losing side of it. The bearish path is entirely realistic, and here is how it unfolds. Suppose Wednesday's minutes reveal a Fed committee more preoccupied with inflation than markets currently believe. Plausible, given that this is the same Fed that paused in June, specifically because inflation has run above its 2% target for years running. If the minutes show hawkish leanings, this week's rate cut optimism could simply evaporate. Suppose Thursday's claims then come in lower than expected, suggesting the labor market is sturdier than last week's report implied, and that the weak payroll number was noise rather than a trend. That removes the Fed's primary rationale for easing. And suppose Friday's inflation expectations reading comes in hot. That would be close to a knockout blow, a signal that the Fed cannot cut rates even if it wanted to, because its principal mandate forbids it. Under that sequence, silver could surrender a meaningful share of this week's gains and retest lower ground. Serious analysts are already flagging exactly this risk, that a still resilient labor market paired with sticky inflation could cap silver's advance and keep the Fed's posture tighter for longer than the bulls currently expect. There is also a simpler, more mechanical risk worth naming plainly. Silver has just run from the high 50s to the low to mid 60s in a matter of days, a sharp and rapid move, and sharp, rapid moves invite profit-taking almost as a matter of physics, independent of what any report says. So here is the honest summary, offered without the false comfort of certainty. Next week is genuinely two-sided. The setup is a coiled spring, and a coiled spring, by its nature, can release in either direction. Anyone who tells you with confidence which way it breaks is not analyzing the market. They are guessing, and dressing the guess in the costume of conviction. What you can do, instead of guessing, is understand the mechanism well enough to read the reaction correctly as it happens, which, I promise you, is worth a great deal more than any single prediction, mine included. But before we get to the practical business of reading each report as it lands, there's something running beneath all of this weekly turbulence that deserves your full attention, because it is easy to lose sight of amid the noise of a data-heavy week. And if you have found this kind of grounded, unhurried breakdown useful, this is exactly the moment to hit subscribe and turn on notifications, because I intend to walk through each of these 3 reports as they actually land, in plain language, with both sides represented honestly, and I would rather you hear it from someone willing to admit uncertainty than from someone selling you false confidence. All 3 of next week's reports and the Fed decision they feed into govern one thing only: the short-term sentiment-driven price of silver. That is the surface of the ocean, choppy and attention-grabbing. Beneath it runs a current on an entirely different timescale, one that does not care in the least what the jobless claims number says on Thursday morning. More than half of global silver demand is now industrial, and that demand is expanding for reasons that have nothing to do with central bankers. Solar installations continue to multiply worldwide. Electric vehicles consume meaningfully more silver than their gasoline-powered predecessors. And the build-out of data centers, driven by the artificial intelligence boom, requires silver in nearly every piece of electronics involved. China's silver imports in just the first 2 months of this year reached their highest level in 8 years. Industry quietly pulling in real physical metal to build real things, entirely unmoved by what the Fed says on a Wednesday afternoon. Meanwhile, roughly 70% of the world's silver is produced not as a primary objective, but as a byproduct of mining other metals, meaning supply simply cannot respond quickly even to a considerably higher price. If silver dips on a hawkish surprise next week, the cause will be the short-term rate story. The deficit will not have changed, the AI and solar demand will not have paused, the supply will still be stuck. That distinction is the one thing separating people who panic at every headline from people who actually understand what they own. Now, the practical matter, because understanding a mechanism without knowing how to read it in real time is like owning a fine barometer and never glancing at it before stepping outside. For Wednesday's Fed minutes, listen past the noise for one thing only: the balance of concern among committee members. Are more of them anxious about a softening labor market, or more of them anxious about inflation that refuses to fully recede? Concern tilted toward the labor market reads as dovish and favorable for silver. Concern tilted toward inflation reads as hawkish and unfavorable. Pay attention, too, to any language suggesting deep division within the committee. A badly split Fed is a Fed less capable of moving aggressively in either direction, and mild paralysis at the center tends, on balance, to help silver rather than hurt it. For Thursday's jobless claims, the rule is blessedly simple. If claims arrive higher than markets expect, that confirms a labor market losing steam, which nudges the Fed toward easing and is bullish for silver. If claims come in lower than expected, that confirms resilience, which supports a Fed content to hold rates where they are, and that is a headwind for silver. Higher claims help silver. Lower claims hurt it. That is the whole rule, and it is worth writing on a sticky note. For Friday's inflation expectations reading, compare it against the prior month's figure. Falling or stable expectations give the Fed room to maneuver toward cuts, which is bullish. Rising expectations tie the Fed's hands regardless of what else is happening in the economy, which is bearish. This is the report the casual observer skips past on their way to the more dramatic headlines, and that is exactly why taking it seriously gives you a genuine edge over the crowd. Here is the governing principle beneath all three: react to the data, not to the candle on your screen. If silver jumps on a report that was, on close reading, actually hawkish, treat that rally with suspicion. It may not last the day. If silver dips despite genuinely dovish data and an unchanged physical supply picture, that dip is very possibly noise, not signal. The investors who lose money in a week like this are the ones chasing green candles and fleeing red ones. The ones who come out ahead are the ones reading the actual reports and understanding, before the market fully digests them, what ought to happen next. It helps to remember, too, that silver has a well-documented history of moving with a speed that unsettles people accustomed to calmer assets. Earlier this year, silver ran to an all-time high above $120 an ounce on a surge of demand meeting a tight market before a hawkish Fed turn and higher margin requirements sent it tumbling back into the 50s, a round trip that would take most equities the better part of a decade to complete, executed by silver in a matter of months. Go back further, and the pattern only sharpens. In 1980, during the Hunt brothers' notorious attempt to corner the market, silver rocketed from roughly $6 to nearly $50 as physical demand simply overwhelmed the paper market above it. In 2011, it ran from under $20 to nearly $50 in about 8 months before reversing hard. In both episodes, silver moved several times faster than gold because it is the smaller, tighter, more combustible of the two metals. Silver does not drift gently. It coils, and then it lunges, in either direction, without much regard for anyone's comfort. Which brings me to the single most expensive mistake I expect a great many silver holders to make next week: reacting emotionally to the first move rather than the correct one. A report lands, silver lurches upward, the excitement becomes genuinely intoxicating, and people pile in near the top, chasing green out of fear of missing out. Then the next report cuts the other way, silver reverses, and those same people sell in a panic at a loss. Bought high on emotion, sold low on fear, whipsawed within the span of a few trading days by nothing more than their own reactions. That is precisely how a volatile week transfers wealth from impatient holders to patient ones. The remedy is not complicated. Decide, before the reports land, what you believe and what you intend to do about it. If your reason for holding silver is the long-term physical deficit, then a hawkish surprise that dents the price this week does not touch your underlying thesis. It may even be the opportunity you were waiting for. Do not let a 3-day data reaction unravel a multi-year argument you found convincing for entirely different reasons. So here is where all of this leaves us. This week's jobs report broke silver out of a 7-month slump by cutting the odds of a Fed rate hike nearly in half almost overnight, and pushed silver from the high 50s to roughly $62 to $63 an ounce as of this recording. Next week hands the market 3 more chances to move that same lever. The Fed's minutes on Wednesday, jobless claims on Thursday, and inflation expectations closing out the week. A dovish trio landing on a physically starved market could genuinely ignite a larger move. A hawkish trio, especially after such a rapid ascent, could send silver retreating just as sharply. Nobody honestly knows which way it breaks, and I will not pretend otherwise merely to keep you watching. What I can offer you is the map. Watch the 3 reports, apply the simple rules we just walked through, and understand what is happening in real time, rather than reacting a beat behind everyone else. Underneath all of it, the deeper current keeps moving regardless of what any single Thursday brings. A 6-year physical shortage, industrial demand from solar, electric vehicles, and artificial intelligence that shows no sign of slowing, and a supply chain structurally incapable of catching up quickly. The reports move the price. The shortage moves the value. Confusing the two is how people talk themselves out of a sound long-term position over a single volatile week. So tell me honestly, of the 3 reports landing next week, which one do you think will move silver the most, and why? The Fed's minutes, Thursday's claims, or Friday's inflation expectations? Leave your answer in the comments. I read every one of them, and the disagreements down there are often sharper and more honest than anything you'll find on mainstream financial television. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.